Hey everyone, welcome back to another video. A few days ago, I put up a story on my Instagram asking if you guys wanted to know more about how traders handle their taxes, how it works, what the structure looks like, and what most traders usually do when it comes to paying them. A lot of you responded saying yes, that you're curious and want to understand this side of trading better. Now, I understand why this topic doesn't get much attention. Taxes are serious, and for many people, they're kind of intimidating. A lot of traders and influencers avoid talking about them altogether. It's seen as this complex, maybe even dangerous topic to touch. But today I'm going to break it down and give you a medium depth overview. Not something overly technical, but not too shallow either. Just enough for those of you who are genuinely starting to earn real money and want to know how to handle things responsibly. Before we get into it, let me say this clearly. If you're not yet making 20,000 to $50,000 per year, or about 15 to 30 lakh rupees annually if you're based in India, then this video probably isn't for you yet. And that's okay. It's not a competition. This is specifically meant for those who have reached that kind of income level or are close to it. If you're not there yet, you're better off watching some of my other videos that focus on growing and improving your trading rather than worrying about tax strategy right now. Why am I saying this? Because watching content meant for a different stage of your journey can sometimes do more harm than good. It can mess with your mindset, push you toward goals you're not ready for, and make you take steps you don't fully understand. So, again, unless you're already in this earning range, it's okay to skip this one and come back to it later. Alright, now let's dive into the main topic. When it comes to paying taxes as a trader, the first thing you have to decide is how you want to handle it. Are you planning to be fully transparent and declare everything? Or are you considering only declaring a portion? I think most people already know the difference between those two paths, so I won't get too deep into that. What I'm going to share today is a general overview of how taxation works if you're a trader, and you can decide how you want to apply that. Now, for this explanation, I'm going to talk about two broad scenarios. First, I'll cover how taxes work if you're trading using live brokers. Then I'll explain how taxes work if you're trading through funded accounts or prop firms. Both have different considerations and requirements. Let's start with live brokers. This is where things start to get a little tricky. Most brokers, especially the ones that are popular among retail traders, operate in a gray area. In fact, almost all of them rely on legal loopholes or jurisdiction gaps to operate. And if you're trading with brokers like Exness, for example, you probably shouldn't be openly talking about it everywhere. It's not that it's outright illegal, but it can create issues, especially when you try to explain where your income came from during tax season. Let's say you're making around 2 to 3 lakh rupees a month trading through one of these brokers. If you're at that level, here's the first piece of advice. Don't withdraw your profits all at once. Instead, break it down. Take out 10,000 one day, 10,000 a few days later, and so on. Why? Because banks can flag large, sudden transfers, especially if there's no registered business to support that kind of transaction. If you're just trading from home and a few lakhs hit your account suddenly, the bank may question it. You might not face immediate trouble, but it can come back to bite you during tax assessments. That's why it's important to hire a chartered accountant who understands trading. Not just any accountant, someone who actually knows about Forex, crypto, and how this space operates. They can help you report your income correctly, avoid red flags, and legally save a lot in taxes. It might cost you 10, 15, or even 20,000 rupees per month, but the peace of mind and savings you'll get in return are totally worth it. Now let's shift to the second scenario, prop firm or funded account trading. This is actually much easier to handle when it comes to taxes. If you're only trading with funded accounts, it's straightforward and regulated. You can even tell people that's what you do for a living, and you won't run into any trouble for it. Even here, you'll still need a chartered accountant, but in most cases, any CA can manage it. Since prop firm payouts are typically direct and clean, there are fewer complications in how the income is treated. But there's still one important thing to keep in mind. In trading, there aren't really any business expenses. If you're making money, it's considered pure profit. If you're losing, it's a pure loss. There's no cost of production, inventory, or anything like that, so there's not much to offset your profits. This means that if you're making something like 30 lakh rupees a year or $80,000 a year if you're abroad, you'll likely fall into one of the highest tax brackets. In India, that would be around 30%. And the reason you land in this category is because there are no significant deductions to bring your taxable income down. It's treated as straightforward income. But don't worry, there are legal ways to reduce your tax liability if you're smart about it. You can register a business, run your transactions through that business, and start claiming some deductions. For example, if you're renting a house, you can rent it under the business name. If you buy a laptop or a desk, that can also be classified under business expenses. This can help you move from a 30% tax rate down to something closer to 18%. If done properly, this can save you a lot. On a 30 lakh annual income, bringing your tax rate down by just 12% could save you over 3.5 lakh rupees. That's huge. And the best part is, it's still completely legal. There are even more advanced strategies out there, but I'm not going to go into all of them here. This video is just an overview. So, to sum it up, if you're trading with live brokers, you absolutely need a skilled CA who understands the industry. If you're trading with prop firms, it's easier to manage, and most CAs will be able to help you. In both cases, spread your withdrawals to avoid bank flags. And if you're planning to scale up, registering a business might be one of the smartest decisions you can make, not just to look professional, but also to lower your taxes and protect yourself. Look, I know this isn't something people talk about often. In fact, most influencers who are earning don't even pay taxes, but I do, and I've even posted proof on my Instagram stories. That's why I wanted to make this video. Not to brag, but to show you that it's possible, it's important, and it's something you should think about if you're serious about trading long term. Thanks for sticking with me through this one. If you found this useful, drop a like and leave your questions in the comments. I'll try to respond to as many of them as I can. See you in the next video.